Namaskar, I'm Anindya Banerjee, your host in this exciting journey which we will take together about what kind of strategies we use in the commodities market. Commodities are the real heartbeat of the global economy. From the gold in your ring to the oil powering your car. And for traders, they bring something special. High volatility, strong global linkages, and massive opportunities. But with great leverage comes great responsibility and strategy as well. So today, we'll simplify the most powerful trading strategies in commodities derivatives, both futures and options, used by professionals, but explained in a way every retail trader can apply. So let's dive in. Let's understand the different types of commodity strategies or the different kinds of strategies which traders use, professional traders in this market. All commodity trading strategies fall broadly into 4 buckets, depending on how you see the market. First, trend following. Ride the big waves. Let's take an example to understand this. Buying crude oil or gold futures when the price breaks out above a resistance point, right? This is generally the conversation which you will hear with the technical traders. If you're using charts for trading, yes, if it has a congestion and then it breaks out above a resistance line, then you say that I'll be long in the market. If it is opposite, if it breaks down below a support, I'll be short. Means I'll sell that particular commodity futures or options. Now the second type is called mean reversion, which is expecting the pendulum to swing back. Just imagine the market like the price oscillation like a pendulum, right? So it goes to the extreme right and it swings back to the middle, that's the equilibrium, and swings all the way to the left. So it's this kind of a strategy is used when we see a market which is range bound, like it's going up and down within a range. So this is called mean reversion. For example, in silver, if it is within a proper well-defined range, what I'll do, I'll sell at the highs and buy at the lows, right? Then we come to the third, volatility-based strategies. This is not about direction. This trading is about how fast and how quick the move will be. And generally what we see is that such strategies are expressed through the options market. But we also have volatility trading strategies being done in the futures as well, specifically when we have very low volatile phase, a congestion, and then we get a breakout. But generally you tend to see event-based strategies where volatility is expected to rise. Then we see that being expressed through the options market, right? Like a long straddle or a long strangle. And finally we come to what we call as trading big events or event-driven strategies. When news moves markets, example, hedging crude or gold ahead of the Fed meetings or let's say West Asia tensions. Now, timing is everything. Commodities react faster and sharper than equities. That's why volatility in commodities is higher, which is the reason why traders love commodities more than equities. Now let's come to the next thing, strategizing using futures. So if I'm using the futures market, what kind of strategies I will use? So let's start with futures-based strategies, the core of the commodity trading. First, directional trading. Go long when you expect the prices to rise. Short when you expect them to fall. Simple but powerful, especially in trending markets. Example, going long on gold, in this case gold mini, when the US dollar weakens sharply. Second, it could be calendar spreads. Yes, you heard it right, calendar spreads. This kind of a strategy is used both in the futures as well as the options market. So here we are talking about futures. So in this case, I buy a 1 month futures and sell the next month futures to capture the changes in the price difference across contracts. Example, I buy a crude oil April futures and sell the May futures. So if I'm expecting the spread between the 2 months to contract. Now third, we have pair trading. Trade the correlated commodities like gold versus silver, zinc versus copper. When one is overpriced versus the other, you go long one commodity and short the other. These strategies are ideal if you are comfortable with margins and volatility. Now, futures magnify both profits and losses and manage exposure But the most important thing, remember, when you are trading futures, it is very important that you manage your risk, because if you are not able to handle your risk, then it can create much larger losses than you expected. Now let's come to the next part of this, which is the strategies which we use using the option contracts. Options are flexible, powerful, and designed for traders who prefer defined risk with open opportunity. Let's see the first example. First is directional play. Buy a call option if you expect the prices to rise. Buy a put option if you expect them to fall. Your loss is limited to the premium, but upside can be huge. Second, income play, option selling. When market stays sideways, time decay works in your favor. Example, selling both call and put when the crude is stuck in a tight range. But remember, selling options comes with unlimited risk if the market breaks out. Then we come to volatility play, straddles and strangles. Buy a call and put of the same expiry before big events like OPEC or Fed meets. You basically profit from the movement if there is a big move in either direction. Then we come to covered futures. What is this? Combine futures with options. For example, buy silver futures and sell a call option to reduce the cost and cushions. It is very useful when the market is in a range but with an upward bias. So you are buying the futures because the bias is upward, but the overall volatility is low. So that's the reason why you are kind of reducing your cost by selling out of money call options. This is also known as covered call strategies. If this helps you understand the market better, give it a like, share it with your trading circle, and subscribe to Stock Shala for more actionable insights on commodities, currencies, and derivatives.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.